Hello and welcome to another edition of this special series on weekend investing. We do certain studies on market data to help navigate this complex maze of investing and a lot of behavioral science that goes along with it. So while in normal course we may not realize what kind of change of market structure is happening over a long periods of time. This study today will show you how the shift has happened in a certain way within the markets. And what we are doing here is that we are taking the last 25 years of data and studying what is the theoretical sort of part of the market where gains are getting made. So is it intraday gains, is it overnight gains, and how that the market share of these two is changing over a period of time. So and this is purely a theoretical study. Don't try to add transaction cost data to this uh, because you are assuming every day of trade. So this is purely academic from that point of view. So over the last 25 years, Nifty has delivered about 100% returns at about 12% CAGR. Now, at every point of time, markets were different. There was a different market in the 90s, where we didn't go anywhere from, let's say, 1996 till 2003. And then there was a huge bull run, 2003 to 2008, which then collapsed in 2008 by end of 2008. And then the next rally started from 2000 on till 2011. Then there was a lull for 3 years. Then again from 14 onwards till 15, then demonetization, and then again till COVID crack. And then from COVID, we've sort of, gone bonkers since then at about 300% since then. So that has been the journey so far. Uh, of this journey, we now want to segregate this journey in terms of how much of these returns came from overnight gains and how much of these came from intraday gains. So just to explain you what we are intending to do. So overnight gain means buying every day at the close of the day and selling at the next day's open. So in this candle, for instance, this is where the close is. So you're buying here, and the next day you're at open, you are selling there. So it is almost like a daily BTST trade. I mean, if you understand that buy today, sell tomorrow kind of trade. So every day at close you're buying, and every day at open you're selling. That is the overnight trade. Another type of trade that is done in the markets is the intraday trade. And to understand intraday trade, we need to understand what is open. So just to give you a very brief about the pre-market. So a lot of folks don't know about this, but this will uh, give you some more knowledge about how open is decided. So whenever there is a normal market from 9:15 onwards, pre 9:15 there is a phase from 9 to 9:08 where all the orders are collected. So everybody puts in their order. I want to buy at this rate, I want to buy at market, I want to sell at market, so on and so forth. And then the order entry window closes at 9:07, 9:08, and then the system decides by matching all these pending orders where is the best match happening, where most trades will happen, and that determines the open price for the day. So at 9:15 the market opens at that open price, and the intraday trade that I'm talking about is essentially buying at the open and selling at the day's close. uh, Again, buying at the open may not be possible in real terms, because as soon as it opens there may be a change from the open. And of course selling at close also is not theoretically it is possible, but practically it may not be possible, because the closing prices are also average of the last 15 minutes, weighted average. Anyhow, but from a study perspective, from an academic perspective, this is fine. So there are two sets of data, one which is intraday buying and selling, no overnight positions, and the other one is only overnight position and no intraday buying or selling. So we've decided to have these three phases: 2000 to about 2007, then 2007 to 2014, and 2014 till now, phase 1, 2, and 3. In the first phase, This was the era of intraday trades. Why am I saying that? Because in those years, overnight trades made only 5.4% returns. So if you every day, if you bought at close and sold at open, you made only 5.4% average. Whereas in intraday terms, uh, only because 2000 and 2001 were dot-com crash years. Other than that, a lot of transactions gains were happening in intraday, 2006, 2007, 2003, 2005. So a lot of those trades were happening at that point. And if I were to take an overall average, it would be about 14.71% of intraday gains in all those years. Of course, overall it was 21.24, but this was the mix between overnight and intraday in that phase. And you can see that overnight was, much lower. Intraday was much higher from in those 7 years, and the overall performance of the market was 256%. So intraday was the significant part of the gains that were being made in the market. So maybe there was, more intraday opportunity there. Maybe there was more, uh, corporate announcements that were happening intraday, causing moves, or maybe it was more an impact of overseas funds, which mainly from London desk, where they get activated at around 1:30 p.m. during our market day. Somehow, uh, it was more beneficial to do intraday trades than overnight trades in those years. Or maybe it was a function of how much money was getting put in terms of investments, or the delivery trades versus intraday trades, or it could be the function of maybe some uh, rub off of the new futures and options market that started 2001, 2, 3 onwards. From a period of 2008 to 2014, you had the second phase, which involved a very gradual shift of this phenomena, where the overnight trades were becoming more significant. So no single year of losses in these 6 years, and the average gain was 16% for overnight trades. However, intraday trades, of course, because of 2008, also lost in a big chunk, at minus 54% just in this one. 2009, of course, was a big intraday plus year, but overall also intraday trades did not yield much, minus 4% actually. And overall, the markets also did not gain much. So 10.96% was sort of the average, or CAGR, over these periods. These were dull years as we went along. So, people who invested in deliveries overnight gained more. Uh, if you just remained invested, you made nothing. And if you just went every day into the market and sold off at the end of the day, you actually lost significant capital. So this was another sort of form of how the market behaved in those 6 years. Overall, now for 14 years, you see that intraday for these 14 years really did not make any money, and overnight trades actually made bulk of the overall complete market move. 359 is the complete market move, of which 330 was made up by the overnight trade. So overnight trade getting impacted by global moves also. So in this period, you can say that India was, in the second phase, so 2008 onwards, we were more aligned towards global moves, and hence overnight did better than intraday also to that extent. More queues were coming for overnight from global markets than previously perhaps. And then this last phase, where a massive change happened towards the overnight trades. And you can see here that consistently all through these 9 years, overnight trades have given fantastic returns. Intra-trade trades, in fact, consistently have lost money. This is a remarkable and a crazy sort of outcome, which at least I was not expecting, that continuously since the last 8 9 years, intraday trade has lost money. It clearly shows the advent of algorithms in the market. uh, there is overcrowding of intraday players in the market. There is, of course, complete sort of you can say engulfing of the overnight market by global cues. So we are likely moving very much in tune with global markets in the last 8 9 years. So while yeah, the uh, complete market moved only 195%, overnight moved much hugely, whereas intraday was really dumb. So if you were to do only overnight trades, and if one were to assume that there was no transaction cost, you would have made much more than the market, because every day the market is, on an average day, I would say, it would gap up and then move down during the day, and which we are seeing right now also in September as well. Market gaps up, during the day it comes down. Market gaps up, during the day it comes down. So this is another phenomena that is now playing out, where maybe the BTSC trade is going to make a lot of money for folks, because there is significant undercurrent for the market to open up the next day. And if we see the complete picture, you can see that overnight trades actually made 9,000% in this last 24 years, whereas just buy and hold over these 24 years would have made 1,255, and intraday trades have lost 85%. So this is clear cut proof that if you were to try intraday long trades, there is significant probability that you will lose money. If you were to try buy today, sell tomorrow kind of transaction, there is significant opportunity of making money there. And of course, if you did nothing and just held on, you still a good return. So in terms of statistics, overnight more than intraday 3,000 days out of 6,196, 54%. So while it is evenly distributed in terms of number of days, but CAGR is amazingly different for overnight versus intraday. And there is, of course, more strategies that are possible which take advantage of these overnight moves versus sitting with just overnight and intraday buy and hold kind of situation. And of course, you can also see that if you did this, your max drawdown also remarkably came down versus the overall picture. So the risk adjusted rate of return for just overnight trades is just mind boggling actually. And the intraday stats are simply telling you don't even bother about it. So overnight gains have been the major contributing factor for Nifty's performance, especially 2015. Intraday sell-offs, you can say, markets have been primarily giving up in overnight gains, resulting in poor intraday performance. So markets open higher and then just softly come down during the day. There is a regime shift post 2008 where gains began to consistently appear overnight, uh, probably because of more deeper links with global markets, and more crowding of intraday markets by algorithms and by traders. Hence there is an impact there, and let me just explain you uh, an impact there. If you have a lot of intraday players, what will happen? Let's say most people are bullish by nature, and markets are going up, so they will want to buy. Very few people are able to bet against the market. So you buy in the morning, hoping that the market will go up, but by the time market comes down, you are selling, and everybody is selling now because you cannot afford delivery. So you sell, so you sell, you sell. The price continues to come down. The price has come below the natural price where it should have been, and the next morning it corrects itself. Then the same thing happens. Market comes down by 315. People are panicking. They are selling at whatever rate. The overnight guys with money are picking that up. The next day it normalizes, sell again. So this is the behavior that is happening, that people with leverage, people with no intent of taking delivery, jumping in every day trying to make a quick buck, and then giving it on a platter to those who can take delivery, and they will take advantage of those weak prices towards the end of the day, and the next day it normalizes. So the impact is that the longer term time frame based strategies will not have any problem, but very short term time frame strategies, intraday time frame strategies will have a tough time in this market, where it is geared towards overnight gains and for those who can take delivery and take charge and actually invest in the market. So as they say, there is no free lunch. A lot of intraday traders are attempting to get free lunch. We'll not put up much money, but we'll want to make a lot of money. It doesn't happen that way. The traders who will put in for my money for delivery will be the ones who will make money on the markets. Let me know how you like this content. Thank you so much for watching. Please do share this video with your friends and family, and I'll see you in the next one. Thanks. Bye.